here. So, got some construction going on over here. Let me show you. Just to give you a little. Got a guys working the excavator over there, working on the Riverwalk. So you might hear some rumbling and grumblings going on in the background, but that's just those guys working. Want to give a shout out to our man All-Nighter Hyder and Robert Hyder, who are joining in on the listening of the live stream today. All-Nighter Hyder being a very popular figure here on the Uneducated Economist, who is by far probably the greatest networker I have ever met. All-Nighter Hyder knows how to get out there and communicate with people in a way that I am absolutely floored by. It seems like when we go to the economic conferences, everybody knows who All-Nighter Hyder is. Like, everybody is wanting to talk with All-Nighter. He is engaging in conversations with everybody all the time, and it's just quite incredible to see. So thank you very much for joining in today, guys. I really appreciate this. Today we're going to talk a little bit more about how the Federal Reserve simply does not want to bring inflation down. Now, I don't believe that they would really want it up around 5 or 6%, but they do want it moderately above 2%, and they want it there for some time. And I believe that was just recently reiterated in a speech given by, let me make sure I got this right. Oops, that wasn't it. Is that it? No. Sorry, I got so many of them up here now. I just don't even know which one's which anymore. Here we go. Thoughts on the economy and policy rules at the Federal Open Market Committee. This was a speech given by Christopher Waller just October 14th, so like 2 days ago. And in this speech, he had something very interesting to say. Now, every time that I have ever read or listened to the mainstream media talking with the economist out there, predicting what it is that the Federal Reserve is attempting to do, you hear a lot about the 2% goal. Now, when we hear this and we think about it, and most of the time when you are communicating or listening to other communications out there talking about the Federal Reserve's policy, the idea is that they are trying to bring inflation down to a 2% goal, like a 2% target. How do we get inflation down to 2%? It seems to be very sticky above 2%, and that they have never quite got it down to where it is that they would really like it. And again, it's not clarified exactly what it is that they are trying to do with the inflation rate when it comes to their monetary policy. Now, let me see if I can bring this up here. In this speech, Christopher Waller says this: the FOMC's inflation goal is an average of 2% over the long run, and therefore there are some good reasons to think that price increases will be modest going forward. Like, they don't want to bring prices down. They want inflation. They want inflation to be moderately above 2% for some time. And now this does not jive with the mainstream media narrative that they're trying to achieve a 2% goal. They're not. They're trying to have it at a low inflation rate, but they want it moderately above 2%. And Christopher Waller has just reiterated that. The FOMC's inflation goal is an average of 2% over the long run, and there are some good reasons to think that the price increases will be modest going forward. Now, if we take it back just a little bit and we go to the monetary policy strategies for a low neutral interest rate world, you guys know I talk about this all the time. I try to bring up this speech as often as I can because I think it is a very important communication that came out from the Federal Reserve prior to the pandemic, prior to the inflationary scenario. And this is after. Remember, this speech that I'm about ready to quote here came after the great financial crisis, the quantitative easing of 1, 2, 3, and 4, the expansion of the balance sheet of $850 billion to over $4.5 trillion, right? And it failed to produce the inflationary scenario that they were looking for. He says this: today we face an altogether different set of problems stemming from a very low neutral interest rate. This is the short-term real interest rate consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. Now, when we think about the inflation that is persistently too low rather than too high, a lot of times people will say, well, that was from years ago. That doesn't really apply anymore. That's not true. See, there's a statement coming from the FOMC on long-run goals in monetary policy strategies. Now, this is going to change very soon. It's only a matter of time before the Fed will come out with a new statement on the long-run goals and monetary policy strategies. Now, this is what it has to say as of this moment right now, coming from the committee. And it says this: the committee has the ability to specify a long-run goal of inflation. The long-run goal, not like the target, yeah, whatever, right? Because the target's never been achieved at 2%. They've tried. Most of the time they run consistently below or above, but very rarely do they ever land at 2% and maintain a 2% target. Very unlikely that's going to end up happening. But the committee has the ability to specify a longer run goal for inflation. The committee reaffirms its judgment that inflation at a rate of 2%, as measured by the annual changes in price index for personal consumption expenditures, is most consistent over the long run with the Federal Reserve statutory mandate. The committee judges that long-term inflation expectations that are well anchored at 2% foster price stability and moderate long-term interest rates and enhance the committee's ability to promote maximum employment in the face of significant economic disturbances. But it's important to understand what that statement just said. See, a lot of people will hear that and they say, yeah, right there, they just talked about a 2% goal. No, what they said was the committee judges that the long-term inflation expectations, what you expect out of the inflationary scenario. Because inflation expectations is a self-fulfilling prophecy. If you believe that it's a long-run goal of 2% and that the Fed is attempting to achieve a long-run goal of 2%, and it's reiterated out there that it's a long-run goal of 2% and that they're trying to maintain this 2%, you will start behaving in a way that actually achieves the outcome of a 2% long-run inflation expectation. If they communicate it enough, you'll believe it. Especially considering that nobody knows exactly what it is that the Federal Reserve is attempting to do. Since they think it's a 2% target, they think that if they can achieve the 2% target, the long-run goal will be somewhere around 2%. But they never achieve the 2% target. It goes on to say this. In order to anchor the long-term inflation expectation at this level, the committee seeks to achieve inflation that averages 2% over time. Therefore, judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation that is moderately above 2% for some time. Now, this is very important to internalize because most people don't know this. They don't think about the average inflation rate over time and what the Fed is now referred to as a flexible average inflation targeting. Flexible average inflation targeting. And what I find interesting about it is this flexible average inflation targeting has no mathematical formula for figuring it out. Because most people are thinking, how do they come up with the inflationary scenario? They don't care. The inflation scenario has to be a long-term inflation expectation of 2%. The current inflation rate is less important. If you have an inflation expectation that runs persistently too low, then they have to create a situation in which your inflation expectation is going to be running persistently high. Now, going back to monetary policy strategies for a low neutral interest rate world. And it has this to say. Sorry guys, I kind of didn't highlight it, so I have to kind of go back up in here. Okay. Talking about the lower bound, right? So this is going back to John Williams' speech, right? He says, the downward shift in inflation expectation has a second round effect on real interest rates, the economy, and inflation. When policy is constrained by the effective lower bound, this is very important to remember, because the effective lower bound is when the Federal Reserve drops the Fed funds rate to 0. That's the lower bound. They cannot drop interest rates any further to stimulate the economy. They have hit the lower bound, right? So when policy is constrained by the effective lower bound, the downward shift in inflation expectation raises the real interest rates, further diminishing the degree of monetary stimulus, making the downturn worse and reducing inflation even more. You hear this problem that they are facing? That if you have a too low of inflation expectation and the Federal Reserve is at the lower bound of 0, it creates a very big problem for the Federal Reserve as the real interest rates begin to rise. Let me read this again. This was very difficult for a lot of people to understand. It was hard for me to actually internalize what it was that he was trying to say when I first read this a few years ago. But once you get it, it starts to make a lot more sense. Where's that? All right. So it goes on to say this. When the policy is constrained by the effective lower bound, the downward shift in inflation expectation raises the real interest rates, further diminishing the degree of monetary stimulus and making the downturn worse and reducing inflation even more. So now this was very difficult. You think about it. If the inflation expectation is down, how does that raise the real interest rate? And just very simply to understand this, if you were an investor and you were anticipating a 2% return, just 2%, and you had an inflation expectation of 1%, the interest rate that you would receive, the real interest rate, is 1%, what you would anticipate getting after the inflation. If you lower the inflation expectation, you will raise the real interest rate to 2%, what the investor anticipates getting after the inflationary scenario. So lowering the inflation expectation raises the real interest rates. If you have a low inflation expectation, most likely you will not be in a position in your mind to think, I'm going to go out there and I'm going to be spending money in hopes that I will beat the prices or the price increases coming into the future, because your inflation expectation is low. This is how it puts a burden on the economy, by having a low inflation expectation. If inflation expectation was elevated, right, then you would start participating in the economy with the expectation that there is going to be inflation coming to the future. You would make the purchase now rather than wait and pay a higher price for it coming into the future. Right? Now, if you have interest rates that are elevated, right, or an inflation expectation that is elevated, this will increase the monetary stimulus. People will begin to behave in a way that starts to then promote the idea of economic activity, because they are trying to beat the inflation expectations coming into the future. So literally, your inflation expectations is what the Federal Reserve is trying to control in order for them to achieve the monetary policy in which they are looking for. When they are at the lower bound of 0, monetary stimulus from the adjustment of interest rates is no longer an effective tool. Now, a lot of times people will take into consideration right now, it's just like, yeah, dude, but the Fed funds rates are up at like 5% now, right? And they dropped them a little bit, but they're still well elevated above the lower bound of 0. What else does he have to say here? Because he's talking about the neutral interest rate, right? The downward, let me get back in here real quick. Oops, where am I at here? I'm sorry, guys. Okay. What does the low neutral interest mean for monetary policy anchoring? When the recession hits, central banks may not be able to reduce interest rates well below their neutral level to stimulate the economy as warranted, because of the effective lower bound on nominal interest rates. Now, that neutral interest rate that he's talking about, right, this is the rate that is neither accommodating nor restricting the economy. It's neutral. It is very close to the lower bound of 0. Now, over the last few years, as we have had the inflationary expectations and the inflationary scenario and all that, interest rate rising and everybody thinking that, the whole world is coming undone, that started to raise the neutral interest rate some. So the conditions in which that the Federal Reserve was facing back when this speech was written in 2018 has changed some. See, before, the problem that they were facing was an inflation or a neutral rate that was very close to that lower bound. Well, if that rises, that gives them some room to stimulate below the neutral interest rate. Here's the problem. The neutral interest rate hasn't risen enough. Has it gone up some? Sure. A lot of times, economists out there, Fed predictions, all kinds of people are saying that it's somewhere around 2.5%, but nobody knows because nobody can observe the neutral interest rate in real time. You can only observe it over time after it's already occurred. You can look back in history and say, okay, this is where the neutral interest rate is. But being that even if it was at 2.5%, the typical Fed move would have an interest rate drop of around 5% in order to stimulate the economy. Even if they were to take interest rates to zero today, they would not be able to drop far enough below the neutral interest rate to actually stimulate the economy. Not in the way that they had done in the past, the way most people would have anticipated the Federal Reserve working their monetary stimulus. Dropping interest rates or the Fed funds rate 5% would get people out there borrowing money to buy houses and cars and go on vacation. But that's when the neutral interest rate was not as close to the lower bound of zero as it is today. Now they have to use their words. They have to use forward guidance, jawboning, credible threats, and owning your inflation expectation. So long as they have that well anchored at 2%, they can continue to operate their monetary policies. And this is, again, very difficult to internalize all this stuff. I've been breaking this down over many years. I have now come up with my own theories as, considered the credible threat theory, which is essentially the Federal Reserve putting out information in a way that then guides the markets into what it is that the Federal Reserve needs for their monetary policy. You can see this working quite well if you take in the idea of stuff like the dot plot map and how many people look at the dot plot coming from the Federal Reserve, which is a prediction of where these FOMC members, the Federal Open Market Committee, believes that interest rates will be in the future. They give their best idea of what it is that is going to be taking place. The problem with this is, and most people don't internalize or think about, is that the times that they are putting out this future projection of where interest rates are going to go, it's based off of current market conditions. If these conditions continue this way, we will be doing this. Here's the thing, the conditions never stay the same. They always change. See, back at the end of last year, there was the dot plot that came out saying that there was going to be 7-8 interest rate cuts, throughout 2024. So far, we've gotten one. There's even a lot of talk that there may not be any more. Most likely, they're probably going to cut again at the next meeting. But it's far from the 7 interest rate cuts that were predicted taking place at the end of last year. Now, when that information came out, look what happened to mortgage rates. Mortgage rates were 8% at the time of that statement. They dropped all the way down into the 6% range. They're now moving back up towards around 7. Now you think about it, the Federal Reserve has made one interest rate cut since that time. A 2% mortgage rate drop since that statement of the dot plot predicting 7 rate cuts that never did happen actually got the market to behave in a way that lowered the mortgage rates. With the expectations, with the belief, with the knowledge that was presented to them throughout the mainstream media, throughout all the different social network channels, through all the articles and newspapers, everybody was in anticipation of it, and they behaved in a way that created the scenario that the Federal Reserve was looking for. They were able to lower the mortgage rates without doing anything. They sat on their hands the entire time. The moment that they changed position and everybody knew that the mortgage rates were going to come down after the Fed lowered rates, the exact opposite happened because of the people's expectations of why the Federal Reserve was cutting rates. They became very fearful. They thought, man, this is a bad sign. This is showing that there's weakenings, that the weakening in the labor market, you know, the problem with the economy slowing down, all this like fearful information started being presented, and the people started acting and behaving in that way. And what do you see happening? You saw the mortgage rates actually increase. Very opposite of what it is that the people were anticipating. All right, how far are we into this? 20 minutes. We're going to consider it there. You guys have any questions, statements you want to go with? Thank you all for being here. We got Brody says, hit the like button on the way into the stream, please, everybody, because that will make YouTube share it more widely so we get more interesting questions in here. Yes, thank you, Brody, for being here, man. Are we starting? We are starting. We started. All right, yo, we got Kevin from Lakeland, Florida, man. Good afternoon. All right, Brody says we are. Justin says hi. Liberated Doc 1 says, hey, UE. What's up, Liberated Doc? Rizzle, long time, first time. Financial Firefighter, great to see you up in here. Aloha from Hawaii. Aloha. All right, smash the thumbs up button. Thank you. Thank you, Rizzle. Nizzle? What is it? Nizzle, is it? Can hardly see it. All right, Sinister Silverado. We need 10% annual deflation. Ooh, yeah. Probably, like, I mean, as a saver, I would totally agree with that. Like, as a saver, I would totally be down for a deflationary scenario and watch my purchasing power go up. The only problem that I'm going to push back against is that a deflationary scenario is absolutely horrible for business activity, for economic activity, for employment, all that other stuff. It's going to be a terrible scenario. I'm okay with it. Like, I'm cool with the idea of a deflationary scenario. I really truly am. But ultimately, I think the broader economy and most people will suffer in pain and misery in a deflationary scenario because most people are not savers. Most people are dependent. All right. All-nighter, we're listening. Thank you, buddy, for being here. All right. Nizzle, love this shit, Simon. Yeah, you bet. Todd says, UE is God. I don't know about that, man, but thank you very much. Todd, that is not necessary. Oh, it's okay. All right. Leave a like, please, guys. Only cost a dime. All right. Calling 10 on the dice. Thank you so much. We'll see. Gotta give a quick blanket hello to everyone. All right, good morning, UE fam. All-nighter blanket hello there. Yo, 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 time for the hydrogen show? All right, let's see, hydrogen is going off there. Please don't spam the chat. Thank you, Brody. All right, what is this, Terminator stuff? What's up, guys, starting from the top. Brody says, hey, Putz. All right, legends, 124 watching now. Everyone hit that like video. Thank you. Hit the like, the video. All right, thank you so much, man. Yeah, please hit the like. Okay, greetings from Canada. Thank you, Brody. Greetings from Canada, where inflation came in at 1.6. Our governor and B of Canada is reducing rates by 50 basis points very soon, but pay attention to fiscal policy. Spending is what is inflationary. Yeah, you know, inflationary, this is what's, I mean, I don't necessarily believe that it's just monetary or fiscal policy that's going to do it, because if we just take it down and say, okay, it's fiscal policy that does it. If when the government spends, inflation, it happens. Okay, I can agree with a lot of that. I can agree that there's, you know, that's part of the equation. But ultimately, where does inflation come from? It comes from supply-demand imbalances. Like, because most of the time when we think about inflation, we're thinking price inflation. Inflation is the expansion of money and credit. Prices are the results. Right? That's like the symptom of inflation. Inflation is the expansion of money and credit. But just because you expand the money and credit doesn't mean that everybody has access to it. And if everybody doesn't have access to it, then only a select few people actually have access to it. And what it is that they do with that new money is where the inflation is going to find itself. So during quantitative easing 1, 2, 3, and 4, where the Fed was able to expand the balance sheet, expand the money supply, expand the inflationary scenario, What they did not do is actually create inflation. So this is a problem considering that the government was doing massive government spending at the time. I mean, from 2008 all the way up to 2018, there was a lot of government spending that was taking place during that time that failed to produce the inflationary scenario that the Federal Reserve was looking for. Not only was John Williams complaining about it in his speech, Monetary Policy Strategies for a Low Neutral Interest Rate World, but Donald Trump at the end of his administration was saying the same thing. There's no inflation. The Fed should be printing money. Give me some of that low negative interest rates. The rich people in the room know what I'm talking about. That's what Donald Trump was saying, because all that money printing failed to produce the inflationary scenario that the Fed was looking for, even though there was tons of government spending at the time. So again, we have to take into consideration why there is inflation. Inflation comes from supply-demand imbalances. So if you have an increase in aggregate demand, that means everybody's spending money at the same time on the same channels that they normally would spend. They just increase their spending. That's what creates the supply-demand imbalances. This is what creates the inflationary scenario. But if you are in a position in which that you have historically low unemployment, and yet it still doesn't create the inflationary scenario, because all these people who are working, more people consuming, more consumption throws the supply-demand imbalances off. But if it doesn't create that situation in which that the increase in employment or the lowering of unemployment doesn't create the inflationary scenario coming to the economy from the Federal Reserve's anticipation that everybody working would then go out there and spend that money, creating the supply-demand imbalances, there's an insensitivity to that taking place now. It doesn't work like it used to. There was a time that we could have said, yeah, government spends, that money goes out there to the economy, more people get hired, people start spending that money that they have earned, creating the supply-demand imbalances. But we recognize after the quantitative easing or the great financial crisis and all the quantitative easing of 1, 2, 3, and 4, failing to do that, it failed it. All right? So it doesn't work that way. What we had to figure out, what we have to figure out now, is how come we had such an inflationary scenario over the last few years. And now, by me studying the lumber industry as closely as I did, I was able to really accurately predict the lumber market by saying, hey, this is a supply chain breakdown. It had been breaking down for years before the pandemic. I was calling it out on my videos all throughout 2019. Once a week, I was talking about another mill curtailment, another mill closure, another inventory depletion, all throughout 2019. So when 2020 hit and the COVID hit, and all of a sudden there was no lumber out there, and the demand for lumber shoots through the roof off of all these stimulus checks and people moving out to the suburbs, or moving from the concentrated areas out to the urban areas, moving away from the city places and trying to build or relocate their office workspace into some other location, the demand for construction and lumber went through the roof, and there wasn't a whole lot of supply. Prices went skyrocketing. Everybody pointed at the Federal Reserve saying, this is the money printer causing this. And I'm like, well, do you think that maybe it was the lack of production? Maybe it was the supply chain breakdown? Maybe it was the fact that there's just nothing out there to purchase when you have contractors who have a contract to build and they have no other choice. That is inelastic demand. They can't postpone this purchase. They must do it. And there's really not a whole lot available out there. What's going to happen? Supply-demand imbalances. It was so easy for me to see. And yet everybody who doesn't see the supply chain breakdown part of things, because it wasn't really well communicated out there within the mainstream media, and this is where most people get their information, is off of these articles coming out on the news, nobody understood why it was that lumber was moving up as high as it was, and it just came down to simple greed. That's all they could blame it on, because they couldn't see it any other way. Right? Understanding it for what it really is. Understanding that the money printer go bird doesn't necessarily create the inflationary scenario. That is so hard for a lot of people to understand. But yet, if you just go back to the great financial crisis and look for the 10 years after that, you're going to see, man, there was a huge expansion of the balance sheet that didn't produce the inflationary scenario. So we have to throw that out the window, that it's money printer that causes it. It's not, right? If it was, it would be simple for the Federal Reserve. They would not be facing a problem these days of an inflation expectation that was persistently too low rather than too high. In fact, he goes on to say, what is it? Let me see if I can find it here. Here we go. The downward shift in inflation expectation has a second round effect on the real interest rate when policy is on the economy and inflation. When the policy is constrained by the effective lower bound, the downward shift in expectation raises the real interest rates, further diminishing the degree of monetary stimulus, like we were talking earlier, making the downturn worse and reducing inflation even more. Even in times when policy is not constrained. See, this is again like right now, the policy is not constrained. We're well above the lower bound of zero. We're above the neutral interest rate. We are not sitting in a policy that is constrained by the lower bound. Even in times when policy is not constrained, the expectation of below target inflation in the future affects current decisions. Making current decisions, putting additional downward pressure on inflation. In other words, monetary policy is always swimming upstream, fighting a current of too low of inflation expectation that interferes with achieving the target inflation rate. You hear what they're having to say here? Like, so different from what you would anticipate coming from all the mainstream media articles, from all the economists, all these people out there who are saying, oh, the Fed lost control. They don't know what they're doing. Inflation's going to run rampant. They have no idea. All that stuff that those people were saying that was going to destroy your world is exactly what the Federal Reserve needed. This is exactly what they needed. They needed an inflation expectation that was persistently too high, because monetary policy is always swimming upstream, fighting a current of too low of inflation expectation that interferes with achieving the target inflation rate. It's so different from what anybody else would be talking about. Okay, let's move on down here. Since the Cold War, America plays poker with USSR plays chess. This is all very American thing the FOMC does, bluffing to direct the market. I don't know. I don't see it that way. Alright. The 72-month at 20% interest rates for the Hellcat. I've seen it. Alright, UE. Any opinion on asteroid mining, lunar mining, and space travel? I like the idea of it. It seems, kind of cool and, sci-fi kind of stuff, go out there and mine these. But, you think about it, like, how much would it have to sell for in order to go all the way to space to get this stuff and bring it back? And then if you did bring back an abundance of it, you would lose value. Like, you would say, oh, well, we have a production. Like, even if, gold was, $100,000 an ounce or something like that, and you're like, hey, we can use this to go to space, get this big old chunk of gold out of space and bring it back. Well, you bring all this gold back and the price of gold would plummet. The credible threat alone that you could do it would start lowering the gold price. It's just like the gold machine, if a guy could say, hey man, I got this idea, I can go out to space and get a chunk of gold and bring it back, like a huge chunk of gold, way more than you could ever possibly imagine. That's very much like the scenario of a guy who invents a gold machine. And with that gold machine produces much gold at will with very little cost or energy. The moment the information gets out that this is going to happen, the price of gold would plummet. All right. So, I think it's a cool idea. I think it's fun to think about, but I don't think it's very feasible right now. When will we get a part 2 on the discount window UE? A part 2? I don't know. We kind of covered that speech the other day, which I thought was really good. I guess once I would assume right now, if you're thinking about the discount window, they are going to continue to evolve in the idea of what it is that they want for this discount window. Because what we learned from... How much time do I have? Okay, I got a few more minutes, guys, and then I got to go. But let's talk about that discount window, because really, ultimately, the discount window was the main tool that the Federal Reserve used to provide liquidity to the banks when they first came into existence. The banks basically abused it And so the Federal Reserve made it like difficult for them to use the discount window, which actually was more of creating a stigma that says, hey, if you're going to the discount window, a bank is going to the discount window, then that shows a sign of stress and, you know, uncertainty within that banking operation. And that if another, like if everybody's looking at them going to the discount window, they're like, dude, you're in trouble, right? But that's not the way the discount window had originally been set up. That's the way it had evolved into. Now they're trying to evolve it back into a common tool that can be used to provide liquidity to the banking system again without that stigma attached to it. Now, how that evolves and what that actually looks like, I would imagine that is probably going to evolve when it comes to the need for it. Like if we go into economic downturns, if these banks start having issues with liquidity and being able to access liquidity to do the operations, and they're going to the discount window, I would imagine what that looks like will start to evolve and change so that they are not held with this like, hey, you are in bad shape by going to the discount window. They're actually, hey, that's a normal operation. Nobody's going to really think twice about it. So what that evolves like and what that it looks like going into the future, I think is anybody's guess. But I would imagine that is probably going to be a very big deal during the next downturn, because it seems to me that they want that discount window to be the standing tool of operation for providing liquidity. I mean, at least that's what I got out of it when we read those speeches the other day in the members only live stream. And if you are interested in watching those videos, it's $1 a month to be a member of the channel. You'll have access to all kinds of member only videos that we have done where we break down these Fed speeches in a way that we can understand it as working class people to get a better understanding of what it is that we need to do with our lives, because these communications that they are doing in these speeches are to the other central bankers. They are not, I mean, the public can go and read them, and there's no reason why people can't do it, but it doesn't seem to me that these are very well communicated out there on the mainstream media. What is the forward guidance propagandized information that they want to put out there on the people to guide the markets, right? To guide the people's idea of where interest rates are going to go, where the economy is going to go. It's all done through these credible threats, through their words, through their jawboning. But when you read these speeches, it has a whole different kind of communication to it. Mainly, just like what I was saying here about the average inflation rate over time, and that they're actually not going for a 2% target like 99% of the people out there believe. Alrighty, thank you so much, Evan Guy, for being a member of the channel. I really appreciate that, man. All right, guys, I got it. Like one more question, and then I gotta go. All right, UE, why is oversupply considered a bad thing anyway? I know it lowers values, but maybe the issue has to do with how our system is designed. Instead, the system should reward surplus. Well, I guess, you know, I mean, that sounds fair, but I don't think the system is actually designed. I think it evolved. I think it evolved into what it is. Like, I don't think some guy was sitting there back there going, you know, in 100 years, we're going to have this kind of operation going on within the systems. And he wrote this all out, said, here's the system guidelines for, you know, what it is that you're going to do going into the future. I think this is a constantly evolving system that has then grown into what it is today. And I know a lot of people will probably argue with that because they look at all the corruption and abuse within it that says, no, these guys are creating this situation to separate the rich from the poor, to make everybody poor, to take all their efforts for themselves. And it's obvious when you look at it that way. Okay, I would agree that a lot of that stuff happens, but I think that men who are doing that recognize how it is that they can do that because the system has evolved into what it is and we didn't fight it. Like, we don't have to accept fiat currency. You don't have to. Yeah? You don't have to keep your money in the bank. You don't have to buy US denominated assets. You don't have to do any of that stuff. Every single one of us is choosing to do that. We are choosing to go for an hourly wage. We choose to pay our taxes. We choose to invest in dollar-denominated assets. We are choosing the dollar, right? We didn't have to do that. They severed the gold standard back in the early 70s. We didn't have to accept it, right? We didn't have much choice, but we didn't have to participate in that system. We chose to. Yeah. We said, okay, I want to do transactions. I want to be able to earn a living. I want to be able to, buy food and pay rent and do all the other stuff that's going on out there. So how do we do that? And I was like, well, you're going to have to go earn some dollars. That's the only way to do it. You can say, no, I don't want to do it that way, and I'm not going to do that way. And economic activity would have completely crashed, and the only actual economy that would have been taking place were the people who were willing to trade gold and silver. And there wouldn't have been that much. It would have been very few transactions and very few economic activity happening out there. People are like, man, I want to go to work. I want to be able to buy food. All right, we're severing ourselves from the gold standard. Here's a bunch of fiat currency. You don't have to accept it, but you're going to. And they did. Yeah. So I don't believe it's designed. I believe it evolved. And we allowed it to. All right. Great point. People are used to one way. Shake my head. That's it, man. Like, I sit there every day. I got to go, but every day I carry silver with me. Anybody who's willing to trade me whatever it is, if I don't have the money, I can pull these things out. You willing to accept that? I mean, it's like, what, $30 an ounce right now? I got these 2 pieces, which is almost 3 ounces, like $100, right? $100 of silver right there in my pocket. I can't take it to a store. No store, like I can't go down to the grocery store. They're not going to accept it. Not for the weight value of it anyway. If it was if it was an American Silver Eagle, I could spend it for $1 because it has a face value of $1, but that doesn't really seem worth it. Right? So you could put your money into that and you could be outside of the system, 100%, completely outside of the system. It doesn't matter what happens to the banks, doesn't matter what the government does, doesn't matter what anything, right? Because you're completely out of the system right there. So that system that was designed to hold you down, right there's your exit. You can get out right there, right? However, you're going to miss out on opportunity to own property unless you can find somebody to trade silver for it. You're going to miss out on opportunity to be the capitalist in investing into companies that for like a stock position, dividend paying stock kind of position. You're going to miss out on all that stuff. And again, we don't have to do this. We don't have to go out there and put our money towards those things. But if you don't, you're going to have to sit there on the silver and gold and hope that you can find somebody to trade it with. Right? Again, like you can step away from the system. You can be out of it. But most of us want to participate in the system because we want to eat. Right? All right. Great point, UE. Well, thank you, Paul. Thank you guys for being here. I gots to go. It was a great stream today. Another shout out to All Nighter and Robert Hyder. Thank you so much for joining in on today's live stream and being here. All right, I'm going to go. Uneducated Economist. You let me know.